Welcome to the Jay Tyner Show, where we discuss all things wealth management and retirement planning. And as always, the goal of our team here at Semmax Financial Group is to help you focus more on your life and less on your money. Now, as a reminder, check with your current advisor, planner, CPA, and read our disclosure in the video description below. Subscribe to this channel if you want to stay up to date on all of our new content. And by the way, if you have questions or need a 15-minute free consultation, please visit semmax.com or call 336-856-0080.
Hello and welcome. Looking forward to talking to you today about market corrections. I've got Larry here with me. Between the two of us, we've got some different pieces of information, some different tips, and I'd like to start off with talking about what is a market correction. And I'm not going to give you what it is. I'm going to tell you what it's not. What a market correction is not is a 2% decline in the market. It's not a 5% decline in the market, and it's not even a 20% decline in the market. A market correction is characterized by a 10% or more correction from the high, meaning if you have an account or a position and it is off more than 10% from its recent high, that is when we're in a correction. Now, you may have different people that argue as far as, is this based off of the S&P 500? Is this based off of the Dow Jones? But generally speaking, we can all agree 10% off the recent high is what triggers a correction. When we get into more of the 20% or more, that's when we're into a bear market. But when we're in a market correction, it's usually around 4-month period. It can be longer, it can be a little bit shorter, but what drives it and what triggers it can be a couple different things. So Larry, I know there's more than just one silver bullet that says, okay, this is the one solution to stop market corrections, but what causes these things?
Well, typically there are several things, but some of the more common ones are fear.
Okay.
Fear in the market will be a cause for the correction.
Meaning one person sells, you get scared, you sell, and it drives it down.
Right.
Okay.
You see everybody moving in one direction, and so you wonder why. And so you do the same thing, it drives it down. Corporate earnings, that's another thing. When corporations aren't getting what they think they're supposed to be getting, they're not projecting their earnings the right way or whatever. They're putting out that projection and it says, we project that we're going to be lower than what we expect. Therefore, you'll see a correction in the market where people will, adjust accordingly with their own investments.
And this doesn't always mean that those corporate earnings are necessarily bad. It just might not be the outsized returns you were expecting, which can cause that pullback.
Exactly. They might say, we expected a 4% and they get 2 or something.
And isn't another one, I know there's kind of profit selling where people go, it's at an all-time high. So
a
little bit different from fear, but still let's get out while the getting's good.
Right, exactly.
And then jump back in once it's been driven down.
Yeah,
right?
Try to time it.
Okay. Well, and then another question that people have is, what does a market correction mean for my investments, right? What about me personally? How does this affect me? Well, there's a couple things to keep in mind here. One, when you're experiencing a market correction, this may be a good time to look at your portfolio and say, can I do any kind of tax loss harvesting? Is this a good time for me to rebalance or maybe alter a few positions? But it's also a time for you to hold steady. And I hope that doesn't sound counterintuitive, but in that market correction, it's important to remember that we have a market correction consistently. It is normal for the market to go up, to come down, to go back up. And if you start to get concerned or worried the first moment we start to see that drop in the market, what you end up doing is you end up missing that rebound in the long run. So when it comes to your investments, it is a good time to look at it, but it doesn't necessarily mean you need to flee, run to the hills, right? Now, that said, if I don't want to flee, I got to wait for it to come back. So I'm going to hit you with one of the hard ones. How long is it going to take to come back? When will the markets recover?
That's a great question. I wish I knew it all the time. No, in reality, the average is about 4 months. It takes about 4 months for the correction to happen. What you need to understand is, though, you're in this for the long haul, and you need to see yourself through it, because if you're planning for that long-term retirement and you're moving in that direction, then a 4-month correction isn't going to do a whole lot. Plus, remember, you've only lost that on paper until you take that money out.
Right.
So
what you're saying is that in the long term, if I'm thinking about this as a newly retired individual coming through a market correction, you can look at it and go, well, the good news is it usually only lasts about 4 months. The bad news is you're going to go through more of these.
Right.
This is not a one-time
No,
thing.
Exactly.
All right. Well, let's just say this. Bottom line, it goes up and down. Right?
It does
That's
go
kind
up
of the
and down.
takeaway here.
Right.
But there are some things we can do during a market correction. So the first thing right off the top, what would you say number one would be?
Be patient.
All right.
Be patient. Trust your plan. If you've got an actual retirement income plan like we do here at our firm, then you can be confident as well to know that you're going to be okay.
Right.
Because think about your retirement as this big, long timeline. These 4-month increments are really small when it comes to that. So be patient.
Okay. Along with that, I would say don't overthink it. I think it's important for you to look at your accounts. This is something I stress with our clients. You want to look at your accounts. You want to look at how they're performing, how things are going. But if you're looking at it on a daily basis, you may drive yourself crazy. You're overthinking it. One moment you're going to look and you go, oh my goodness, I can finally buy that yacht I've always wanted. The next day, I'm living off of Pringles and PB&Js. That's all I can afford.
That's right.
And it's because you're overthinking those movements, those short-term movements in the market. So what's the next one?
The next one's going to be fight your instincts.
Okay.
Your instincts are to look at it every day. And take it from somebody like myself, I have no hair because I used to look at the market every day. So
Right.
so anyway, fight your instincts. Honestly,
Right.
don't be so nervous or anticipatory just to jump out, trust your plan again.
And there is actually a theory around market analysis that is the odd lot theory, which says whatever the individual investor does, which is an odd lot, which is usually less than 100 shares at a time, right? If you're buying in 100 share lots, that's an even lot, right? So if you've got 57 shares of Ford and you say, I got to get out, and you're selling, or this is a great time to buy, you're buying, there's an entire philosophy built around doing the opposite of what the individual is doing, and that really speaks to those instincts
Right.
that you're mentioning.
Exactly.
Another one that I would say is key, and this is something that you want to have done before the market correction, but you may want to take, if you haven't done it before, now's a good time to do it, is to stay diversified. We all have certain companies that we like. We all have certain things that we like, and it's not always the same. But I think it's important to stay diversified. Maybe you like dividend-paying stocks. That's great. But instead of having 2 or 3 dividend-paying stocks, you need to have a portfolio of 20 to 30 spread across different sectors, spread across different companies, different risk factors to mitigate that downside in a market correction. So I would say stay diversified, and even if one of those is experiencing a little bit more of a downturn in that market correction, that's where that diversification comes into play. You can capitalize off of that. And then take it away. What would you say number 5 is? And I would say this is probably the most key personally.
Of course. Yeah. I would say number 5, the most important one, work with your financial advisor to constantly reassess your situation.
Right.
Your retirement, your income plan, whatever you want to call it, it's a living, breathing entity that you have to constantly be prepared to adjust.
Right.
Because things change. So work with your financial advisor. And if you don't have one, obviously, come see us. But seriously, work with your financial advisor so that they can help you get through these market corrections.
And I know one thing that we do here at Semmax proactively, building off of that, is whenever you meet with us, we're going to put our next appointment on the calendar, because I don't know when we're going to have that market correction. It may start happening in 12 minutes. It may be another 6 months, but we know at some point in time the markets will experience volatility. They will go up, they will go down. And if I don't know what the market's going to do 6 months from now, but I know we're meeting, that gives me a measure of comfort. That should give you a measure of comfort, knowing that we have a plan in place. We're addressing and we're looking at things regularly. I would just say this: if you're having trouble getting a hold of your advisor during a market correction, that's a big old red flag for me. with that said, I hope this has been beneficial for you. If you have any kind of further questions, if you have any kind of concerns, don't hesitate to reach out to us here at the office at 336-856-0080. For Larry and myself, representing the Semmax family, thanks for watching. We hope you have a wonderful day.